Cautious remarks from Fed members and the spike in oil prices hammered the risk appetite ahead of today's most important U.S. jobs data in the U.S. And a hotter than expected jobs data from the U.S. could further spoil the dovish Federal Reserve expectations and darken the mood. So welcome, this is Swissquote's Daily Market Talk. So risk appetite got a hit yesterday as an army of Fed speakers sounded cautious about the timing of the first interest rate cut from the US, and as the barrel of Brent spiked past the $90 per barrel level on rising tensions between Iran and Israel after Israel bombed the Iranian embassy in Damascus earlier this week. Remember, the barrel of US crude also spiked, and it spiked to 87.5 level yesterday. So far, tensions in the Middle East didn't really impact the global oil supply significantly. Hence, we actually saw a sustainable rise in oil prices, but not a spike. But Iran's direct involvement could mark a new milestone in this Middle East conflict and could back a rapid rise in oil prices in the near term. And in this context, we can't really rule out the risk of a short-term rally in oil prices toward the $95 to $100 per barrel range. Now, note that these rising oil prices are not benign, because the latest spike that we see in oil prices will likely be reflected in the upcoming inflation reads in the US and elsewhere, and may derail the Fed from its 3 rate cut plans for this year. And indeed, when we listen to the Fed speakers these days, we actually start sensing that, there is an increasing caution regarding that expectation of 3 rate cuts. Because Neel Kashkari, for example, who used to be a dovish voice at the Fed, said yesterday that the January and February inflation readings in the US were a little bit concerning, and that the Fed may not cut its interest rates at all this year. Happily, he doesn't vote this year. But earlier this week, Raphael Bostic also said that he expects just 1 rate cut this year from the Fed, and that after the election. And Patrick Harker and Thomas Barkin also backed the idea of a patient approach from the Fed towards rate cutting, as the uptick in inflation and rising oil prices don't necessarily point at further easing in inflation in the US toward the Federal Reserve's 2% policy target. So the combination of cautious Fed remarks and this oil rally spoiled the market mood ahead of today's all-important US jobs data. The S&P 500 fell more than 1% yesterday as Nasdaq 100 retreated 1.55%. The US yields, on the other hand, remained soft on the back of a certain flight to safety, and the US dollar rebounded today in Asia after hitting a 2-week low level. Now today, all eyes are on the US jobs data that should distinguish between those betting that the Fed will cut rates 3 times this year and those who bet that the Fed will barely cut the rates this year with this strong economic growth and rising inflation. So the US economy is expected to have added 212,000 new non-farm jobs last month. The average earnings may have accelerated on a monthly basis but decelerated on a yearly basis. These are the expectations. Then the unemployment rate is seen steady at 3.9% level. Now note that the mention of job cuts in earnings call from the S&P 500 companies have been rising since the beginning of this year, yet we haven't seen a material impact on the official jobs data just yet. In fact, the past 3 NFP numbers actually exceeded the market expectations by around 78,000 jobs, and the US economy added around 280,000 new non-farm jobs on average per month over the past 3 months. So another higher than expected NFP number and hotter than expected wages growth could actually lead to a further pullback in dovish Federal Reserve expectations, weigh on stock and bond valuations, and boost the US dollar. The sweetest combination in all this would be, a reasonably good NFP number combined with softer wages growth that would actually cement the expectation, the idea of a soft landing for the US economy. Now, one of the reasons why the US economy is performing this well and better than the rest of the world, especially European peers, for example, and this is something that we discuss in the comments of our previous videos, our previous episodes, is, well, the US government is obviously spending big money, and that hasn't slowed at all this year, while the European governments just bumped into a kind of strict budget discipline. And another reason why the US consumers have been this resilient to the interest rate hikes in the US is the rally that we saw in the S&P 500 and other major stock markets, which added to the Americans' wealth as Americans are heavily invested in the stock markets, and the impressive performance of the US stock indices actually gives you an indication, an idea on how they actually saw their wealth build up over the past couple of months, and that probably helped them cope with rising interest rates as well. Now, the company earnings, on the other hand, have been robust. So all this is quite good for the economy, but the three-cut expectations remains vulnerable due to, well, these strong economic fundamentals. And, well, further strength in economic data could further spoil the expectation of 3 rate cuts. But whether a further pullback in Federal Reserve's rate cut expectations weigh on the US markets and the US stock valuations remains yet to be seen, because something that the US stock rally has further room to run with or without the support of the Fed. Bank of America, for example, has this sentiment index on sell-side analysts, so on people who are actually on Wall Street and who are giving recommendations to their clients to buy or sell the stocks. And, well, Bank of America believes that an extreme bullishness or an extreme bearishness from the sell-side analysts, hence that the market is ready to reverse. But for now, well, their index is in the middle of two extremes, in the middle of extreme bullishness and extreme bearishness. So in other words, they actually think that this rally that we see in the S&P 500 could extend if the economic data remains in favor. Elsewhere, the minutes from the latest European Central Bank monetary policy meeting show that the Eurozone officials have a clearer opinion on the timing of the first rate hike in the Eurozone. Now, we actually know that the June meeting or June cuts looks like a done deal in Europe, even though the ECB chief Christine Lagarde said that the ECB is not willing to commit to further rate cuts beyond June. And a further fall in Swiss inflation, on the other hand, to just 1% on a yearly basis in March and 0% on a monthly basis, hints that the Swiss National Bank will be actually in a position to opt for more interest rate cuts this year in Switzerland to take advantage of a period where they could actually loosen the Swiss franc and boost the Swiss economy, especially for Swiss exporters that have suffered big time the consequences of a too strong Swiss franc during the Swiss National Bank's fight against inflation during the post-pandemic period. And franc has room to soften because the dollar franc has just reached the 38.2% Fibonacci retracement on 2022 and 2023 sell-off, while the euro franc recovered just a third of the post-pandemic appreciation in the Swiss franc. And carry traders who borrow low-yielding currencies to invest in higher-yielding currencies are gently leaving the Japanese yen, where the Bank of Japan's next move could only be a hawkish move, and turning into Swiss francs for funding their carry trades. And the latter should also give a further support and help the Swiss franc give back some strength moving forward, at least until the other central banks like the European Central Bank and the Bank of England and the Fed decide that it's time to move on their side as well. So this is all for this week. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive messages. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, and on LinkedIn for regular market updates. Subscribe to our YouTube channel for daily market comments, and please do not forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again in a week as I will be on vacation next week. And until then, well, good week trading.